Vistry Group reported a £30 million pre-tax loss for the first half of 2026. A company that built 1 in 7 of Britain's affordable homes last year, now discounting its own unsold private stock by an average of 7.1%. That figure is not a rounding error. In the first half of last year, the average discount was 1.4%. The bottleneck is not a product problem, but a structural one. Vistry built its business around partnerships with housing associations and local authorities, accepting thinner margins in exchange for faster build-out and predictable demand. The bet worked until it did not. When the Iran war raised inflation expectations and pushed mortgage rates higher in the second quarter, open market buyers pulled back sharply. Vistry had £600 million worth of unsold private homes at the start of 2026 and had to start selling them at a loss to generate the cash it needed to service £799 million in average daily net debt. The result is a company in a visible contradiction, operating in a country with a severe and widely acknowledged housing shortage, yet unable to sell homes at cost. That contradiction is the frame that makes today's update matter beyond a single quarterly miss. Vistry is not a distressed speculative developer. It completed 6,100 homes in the first half and holds a £3.9 billion forward order book, 80% of which is already sold for 2026. The mechanism that should protect it, the partnerships model, the affordable housing pipeline, the government program, is the same mechanism that is now creating the pressure. The most contested number in today's update is not the £30 million loss. It is the £200 million full-year adjusted profit guidance that management left unchanged. To get from a £30 million first-half loss to £200 million for the full year, Vistry needs to generate roughly £230 million of adjusted profit between July and December. That is against £228 million in the second half of 2025, when the market was not fighting the Iranian war inflation shock and when average daily net debt was £695 million rather than £799 million. RBC Capital Markets analyst Anthony Codling called the guidance a tall order and the announcement itself not just a missed goal, an own goal, arguing that management failed to use the update to flag the obvious risk that Labour's housing program delays could slow second-half completions. Investec reached a different conclusion from the same numbers. It said full-year consensus profit before tax remained in line, that average net debt is expected to decline in the second half, and that the market should simply wait for September. Two named analysts, the same update, opposing reads. That disagreement is not academic. It maps directly on who is right about Vistry's business model under current conditions. The point most holders are missing is where the actual second-half swing is supposed to come from. Management named 5 sources: higher open market sales volume as discounted inventory clears, completions of delayed partner-funded deals that slipped from the first half, a lower rate of cash generation actions, land sale profits from a reshaped land bank, and confirmation of government affordable housing grants. The first 4 are controllable, the 5th is not, and the 5th is the one that connects Vistry's debt trajectory to a political calendar it does not control. JP Morgan moved before the update, downgrading Vistry to underweight while keeping Persimmon as its top pick in the sector, a positioning move that separated the one builder most exposed to partnership model risk from those running the conventional speculative model. The buried assumption in Vistry's second-half recovery case is the confirmation of government affordable housing grants expected in September under Labour's £39 billion social and affordable housing program. Vistry said plainly that it expects to benefit from this confirmation in September. Housing associations and local authority partners have applied for the grants. Vistry's revenue from those deals flows only once the grants are confirmed and the partnerships can proceed. Anthony Codling's own goal critique pointed directly here. Why did management not use today's update to flag the risk that changes at the top of their biggest client, the government, may slow the deployment of the program? The new housing secretary, the shifting fiscal constraints on the Treasury, the affordable housing program's own delivery timelines, none of these were addressed. The hidden assumption is that the September grant confirmation arrives on schedule and at the scale Vistry's partners have applied for. If it does, approximately £190 million of the unsold stock already in train completes by December. The partner-funded deals that slipped from the first half settle in the third quarter, and the debt trajectory moves toward the £100 million net cash target management has reaffirmed. If the grants are delayed by even 1 quarter, the second-half completions that generate the cash do not land in time. Net debt at year-end stays materially higher than the target, and the £200 million guide becomes indefensible. Vistry also faces a separate legal pressure that management did not address in the update. The company is among 7 large housebuilders facing a class action lawsuit on behalf of an estimated 700,000 buyers of new-built homes, seeking compensation of between £2.2 billion and £4.5 billion on allegations of price information sharing between 2015 and this year. Parliament was told this week that the industry's £100 million settlement offer to the Competition and Markets Authority definitely looks dodgy. This is a discarded chapter item for today. The timing and quantum are unresolved, but it sits on the balance sheet as an unquantified contingent liability at the worst possible moment. The verification event is 24 September 2026. The interim results plus the full findings of CEO Adam Daniels' strategic review. Daniels has already outlined the direction: a leaner regional footprint, a substantially reduced land bank, lower work in progress, and the exit of the part exchange business. The voluntary redundancy scheme is expected to generate £25 million in annual savings from 2027. None of this settles the core question of how deep the write-downs from the CEO review will be and whether they land as exceptional items outside the £200 million adjusted guide or recur into the reported figure. The genuine counter-evidence against the management recovery case is the CFO departure. Tim Lawler leaves in October, after the September review is published, but before the year-end cash target is required to be met. The articles do not record a succession plan beyond "a process has commenced." A CFO who oversaw 4 years of integration, departing 3 months into a new CEO's restructuring, mid-transition, is a timing that the market read as signal rather than coincidence. For a holder, the decision variable is not the £200 million profit guide, which is an adjusted figure with unknown exceptional items layered on top. It is whether average daily net debt falls below £650 million in the second half, as management has targeted. If that metric is tracking toward the target by September, the recovery case is intact. If debt is still running above £700 million in August data, the second half pivot is not happening at the pace required. For a watcher, the entry setup is the September review delivering a quantified and bounded write-down figure, one that the market can put a number on and price through. An unquantified review result, or one that reveals write-downs materially above current expectations, confirms that the kitchen sinking is still in progress, not complete. The distinction between those two outcomes is what decides whether 226p is the capitulation point or a station on a longer decline. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.